Good morning, good afternoon, everybody. This is Dennis Worm with the Active Trend Traders. Welcome to this Friday's edition of How to Make Money Trading Stocks. Today, joining us from Zurich is Michael Bischoff. Michael, how are you today?
I'm fine.
So, hey,
Thank you.
I have to ask this question.
Yeah.
I know that the west coast of the United States is getting all kinds of storms and rain and snow and all that kind of stuff. Are you guys getting heavy duty snow this year too?
Yeah, it was kind of crazy weather this year. December, it was cold December and January, but December no snow, and now we have also quite a lot of snow, but even more really cold temperatures.
Okay. Now I've got some longtime friends that live up in Tahoe, and he runs a ski resort up there in Tahoe, and the snow is really deep in Tahoe. And then I've got another old friend that lives up in Idaho City, Idaho, back in a cabin in the woods, and he's got so much snow that he can't even get to his snow blowing equipment to get it all clear away. So
Yeah, I
anyway,
think that's a
huh?
different story. That's then Scandinavia in Europe.
So I digress, but let's get going. All the materials that we do present are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. You can always go back and read the other rules that we have to live by. Here's Michael's disclaimer. Michael works for a Swiss wealth management company, and there's his email if you ever want to get in touch with Michael. And he does, he follows European rules and regulations, and but he still trades U.S. stocks, which is cool. So let's get in here. Here's a little bit about me. If this is your first time here with the Active Trend Traders, our motto is, I got a hair trigger mouse this morning. Clarify, simplify, multiply. Mike Traeger and I kind of put this system together with a focus on people who are still working for a living. We wanted to make it easier on folks to be able to learn a system that's fairly straightforward and easy to use, but that reduced the learning time that took us, because we were still working for a living before we started trading for a living, and we know that it's a lot. It's a big effort. So I commend everybody who's out there, working for a living and trying to learn how to trade in the stock market. Congratulations, and keep going. So January is just about over. We had a great training session this past Wednesday night. We were tying seasonality up with the leveraged ETFs. All the feedback I got from that presentation was that it was excellent, and it really was beneficial in helping people to be more patient in waiting for their opportunities both in the indexes and in individual industries and commodities. This week we're going to be tying it all together. A couple of weeks ago we finished up a training on some rock solid entry criteria to be able to jump into trades at appropriate points, and that was really good. And so we've been really active this week. We've had a couple of, with the Active Trend Traders, had a couple of alerts go out this week for potential buys. And so that's a good thing. So the market this week, pushing higher. The Trump rally continues. It's kind of funny, those of you who are in the U.S., if you're paying attention to what's going on, I mean, regardless if you are for him or against him, whatever, as the new president, he has certainly got the press just running in circles. I mean, he has basically twisted their head around like a propeller on a wooden aircraft that was tied to a rubber band, and he's letting it go, and their heads are just spinning. One of the things that's really interesting is you have to remember, Trump wrote the book, The Art of the Deal, right, Michael? The Art of the Deal.
Okay.
And so he's a negotiator. He is a deal maker and all that kind of stuff. And a lot of times with people who are negotiators, uh, as you know, one of their negotiation stances are, one is to keep your opponents off balance, what he's definitely doing, but then secondly is you fire for effect. In other words, you make some outlandish, a demand, claim, whatever, and then see what the reaction's going to be, and then you adjust your position appropriately. But so it's, being an old negotiator, I find it very intriguing to watch what's going on. So the S&Ps have pushed up to new highs, so as the NASDAQ, they're basically taking a little bit of profits today so far. Russell lagging a little bit, and is it typically just because it's weaker, or is it because it's just that time of year for the NASDAQ? Correction, for the Russell. The Russell tends not to wake up until later part of March into April timeframe. So outside influences, we haven't heard a lot about earnings. I mean, Google reported earnings and there was a reaction. Netflix reported earnings and they had a pretty good reaction. We've got the other FANG stocks that are going to be reporting earnings over the next couple of weeks. I think we've got Facebook coming up on the 1st, which is next Wednesday, then Amazon coming up on the 2nd. And so we'll see if they're going to be any kind of market movers there. But I totally didn't spell that right. Let me make a correction to this slide real quick, which we can do since I'm right here next to it. There, that's better. Right now, in the markets, I mean, the markets are just, basically seem to be firing on all cylinders. Nothing in the underlying valuations has really changed. It's still overvalued, but it's run on high octane, high optimism. Will we get the post-inauguration drop that tends to happen about 2 weeks after the inauguration? And hence the rest of the question is, will historical norms prevail, or, to use a very overused term, will this time things be different? And we could have an outlier year. You never know. What's the attitude over in Europe regarding? I know there's a lot of consternation about the Trump presidency in Europe. That's what the news tells me, Michael. But what about the markets?
Well, there is not that much going on. I mean, Germany had a very similar move as the Russell had.
Yeah.
So at least short-term correction is overdue. This message was quite popular that Spain is doing better than expected. There were
cool.
Different statistics, and and then a couple of earnings from the big companies.
Yeah.
That were more disappointing than great.
Okay.
I mean, Novartis, it's this huge pharmaceutical company. Was not reporting that good, and you see, it's really about the stakeholder management now, or shareholder management now. Also, the companies that did not do that well, at least in a symbolic way, increased the dividend.
Oh, okay. So that's kind of interesting. So are the newspapers there filled with Trump news?
Well, I'm not chasing all these new things. So yeah, they are, but yeah.
I mean, it's mostly.
Let's wait and see.
Yeah, it's mostly just noise. I mean, it is just.
Exactly.
One of the things that I do is I have a home page for my when I get on the internet is a news organization that I tend not to, I don't necessarily agree with this news organization, but I want to know what the opposition is saying. And so I find it very interesting because I think it's valuable. It's important to hear both people, from sides that are both, those of similar thought, but then it's also very important to listen to what those of, dissimilar thought are thinking and saying. And I tell you, just some of the insanity that's going on out there.
Yeah, I hear you.
Excuse me, I gotta let that. Okay, what just happened here? Hold on just a second. I think I just needed. I gotta check on something, guys.
Yeah, and this was kind of maybe the biggest European news that Merkel will get a new. So the Democrats will, surprisingly, changed. Also agreed on the candidate fighting against Merkel.
Ah, okay. Well, that's interesting.
And that was a surprise. They took one from the European Parliament who has never been in German federal politics.
Yeah. I just, that's kind of interesting you say that. I wonder if this is going to continue to be a habit, not just in the United States, but across Europe. We have Brexit, and there's just like, I just wonder if this thing of people voting in outsiders is going to continue across Europe. It should be interesting. So, this is our percentage of stocks above the 20-day moving average as of today. As you can see, we popped up a little bit, but then it's starting to fall back down. Get back here. We are not necessarily interested in this other than just for informational standpoint. We see we pushed up higher. This because it's measuring two different things. One, dadgummit. One, it is measuring. There, I'm going to start operating from my mouse. Okay, this measures two different things. One, the candlestick charts measures the percentage of stocks above the 20-day moving average on the NYSE, a non-weighted index, and then the bar chart measures the spiders as a stand-in for the S&P. As you can see, it pushed up to new highs, but then the NYSE, the percentage of stocks above their 20-day moving average, which would, the greater the number, the more the stocks involved in the rally and that kind of stuff. And as you can see, that's starting to fall off a little bit. Fairly significant over the last couple of days, even though the weighted S&P, in fact, is just kind of held steady. Yeah, it's doing a little bit of a pullback today, but nothing dramatic. This individual indicator becomes interesting to us when it basically gets down below gets down in these areas down here where it's below 30, and that's when our research has showed us is that once it gets down here within a period of time, within 10, somewhere between 5 and 15 days, you're going to get a turnaround and it'll pop back up. And so when it's stuck in the middle here, it is basically there's no actionable information, and even when it gets above the 80% level, still not a lot of actionable information, because you can see in the underlying here, the S&P has continued to push higher. So, but we just keep it in the back of our pocket right now. No actionable information. It's just that the non-leveraged index is. Fewer of the stocks are above their 20-day moving average. So we can see here, as about 9 o'clock this morning, the Dow is up for the year, a little bit of 1.7, the S&P 2.5, and then what's been very interesting is for the NASDAQ and the NASDAQ Composite, both of them being up 5 to 6%. just during the month of January. So that's where the big gain is taking place in the U.S. market, at least this year so far. Russell got up towards its highs from last year earlier in the week, but now it's pulled back today a little bit. So let's take a look at the individual index charts and see what we can see for going into next week. There we go. There's Tesla. Tesla has been a beast since just prior to the election. But here we go. Here's the S&P. The S&P, as you can see, came up, broke out above the 2280 level earlier in the week, ran up to 2300, and then is basically kind of stabilized there. Not really showing any significant larger sell-off. But one of the things I will keep watching going into next week is, okay, we've got the TSI now. It did come up and make a little bit of a new high, but it's starting to turn over a little bit. It's not overbought by any condition, but it did come up and do a retest up here. On the weekly chart, of course, it's been kind of pushing sideways to slightly up. It is negative divergence from this point back here, which corresponds to this area here. So it is making a new high, but the longer term momentum is lagging a little bit. And the other thing I find of interest is the momentum itself on a weekly chart. Even though the index is pushed to new highs, the momentum line didn't push up at all. So oftentimes that is an indicator that, hey, a more significant pullback could be in the works. And at this point, we'll just we'll wait and see. We are and continue to be in an uptrend, and so with an uptrend, the directions is with the uptrend, play the pullbacks and be patient and wait for the pullbacks accordingly. Last week's, the pullbacks that happened over the last 2 weeks to the 20-day moving average, the 20-day moving average wound up holding on the S&P, and you got this little spurt up to break out to new highs. Now, there is no, well, now that we put in 3 days where 2230 was not broken or with a close, then we know we have some resistance at the 2230 level, and so we can use that in the going into next week for, okay, what do we think is going to transpire? But Michael, right now, still an uptrend, but I think you mentioned something when you were talking a little earlier about the need for an overdue pullback.
Yeah, I mean, there are various statistics and historical charts, etc., indicating that such an up move is exceptional and in most cases not sustainable.
Yeah,
yeah. So we'll see.
Yeah, one of the things that.
But on the other side, I mean, on new highs, it's difficult to say when this stops.
Oh, without a doubt. I mean, the index is definitely not in a place where you're necessarily going to go short, yeah. But because it's not really given any indications that, okay, now's the time to short. We're in an uptrend. The NASDAQ that we're looking at right now, it's in a nice uptrend. Now, it's not in a buying position, and it's not in a shorting position. Let's see, what did Eric say? 2300, not 2230 level. If I said 2230, it was by mistake. Yes, the 2300 level on the S&P. As we can see here, the TSI on a weekly chart has moved to, our daily chart has moved to new highs. We're just about at least back up into the resistance area from these past highs here on the dailies. a little bit of negative divergence as numbers push further up. But as you can see, the Nasdaq has a little bit more strength. The move this week in the Nasdaq over the last couple of weeks has actually resulted in the momentum continuing to move higher rather than down. And then the steepening of the curve on the TSI indicator on the weekly chart shows that more momentum has coming back or has come into the Nasdaq. Mike made an interesting comment on Wednesday night. He was talking about how the European central banks, which do not have the same restrictions on investing in the U.S. stock market, have continued since the election to pour large sums of money into the United States, U.S. stock market, partly due to their interest rates are basically close to zero, in some cases even a negative. Is there still some European central banks that have a negative percentage rate right now, Mike?
Yeah.
Okay.
Yeah. And you have to be careful with this statement about U.S. stock buying, because to my knowledge, the ECB is not allowed to buy any stocks. So they have a similar setup like the Fed.
Like the Fed. Okay, so the European Central Bank can't.
Yeah. So, but there are two really big, or you can really say huge, buyers of Euro bonds and US stocks, and the biggest one, and I would say the craziest one at the moment, is the Swiss National Bank.
Okay.
Because they want to kind of protect the Swiss franc to getting higher and higher.
Okay. And so,
which is, I think, I have a clear opinion on that. It's pretty nonsense, and you see it. I mean, it's pretty stable to the US and other currencies. It's just getting stronger to the euro because the euro is so weak. So I mean, and it's absurd to because I mean the balance sheet is gigantic, and it's really it's 100 or almost 100% paper money.
Well, that's one of the things that Mike said on Wednesday night, is that some of these, I guess it's country central banks, they're printing money, and taking that money that they've been printing and investing that into the stock market. Now there is a risk with that, but they just can't get a return, if within their banks themselves, and so.
No, but that's a different story. So the national banks, they are not going for. The intention is not getting a good return on this.
Okay.
It's basically really a currency hedge.
Okay.
Or a currency play. And the second country, big country doing, or as in terms of money, big country, is Norway, but they have a different background. So Norway, they have a crazy setup that worked extremely well in the last decades. Who knows how this will continue. They have a setup comparable to Kuwait or Dubai or some other Arabic countries.
Okay.
So basically, to my understanding, their oil industry, which is quite big, is owned by the government, and with the money earned is invested in international markets.
Okay.
And I think it's basically a huge pension fund for everybody.
Okay.
And I mean,
Hey.
it's an interesting approach, and I mean, it's a very rich country, and it's also a competitive country. So they have just one segment, basically owned by the government, and that
Hmm.
pours the money to the people. So
So yeah, it sounds a little bit like I mean Alaska, although Alaska is not um,
okay,
but Alaska does that with their natural resources. Apparently, if you're a
okay,
long-term resident of Alaska, some of the oil proceeds that the state collects taxes off of, in fact, turns around and goes back to the occupants or the residents of the state of Alaska.
mhm,
So I don't know how long you're going to live in Alaska before you can benefit from that. But here's the NYSE. Again, it did push to a new high, and now it's coming back and down and testing that support. Now, uh, on anything that has done a breakout like the S&P, the NASDAQ, is be aware of where that level of support is, because oftentimes, prices will basically retrace to that level and maybe even fluctuate around a little bit before, and if the uptrend is going to continue, that's where you'll get a lot of times where you can get a good bounce. As we can see, of course, the TSI looks to be rolling over. Momentum's rolled over. Momentum on the weekly, and TSI looks like it may be running out of gas on the NYSE, which is a non-weighted index and compares fairly favorable with the Russell. Now the Russell pushed back up into the 1380 level, made a nice reversal off just above the 50-day moving average, popped up, and I'm seeing this kind of a pattern a lot on all the stocks, on the stocks that I'm reviewing, is basically this pull down to a new swing low, a push back up, taking a couple of 2 or 3 days, and then a real fast, quick sell-off after that. The big hit, what's going to hinge my decision-making process partially is what is the price actually going to do here around these moving averages. Is it going to, just, continue to, if the sell-off does accelerate, then we're probably going to go and take this level out, the 1341 level, take that out and push further down, maybe down to the 1320 level or so. But I'm seeing this, basically had a strong push up, pull back, thrust up, but it's a weaker thrust. Pull back, still a weaker thrust than the original position over here. More significant pullback, and all the time it's hammering down these moving average, thrust up, and now we're back into a pullback. And so it's almost like we're going 3 days up, 2 to 3 days up, and then 5 to 6 to 7 days, either sideways to slightly down. And so we'll see if this works into just a range-bound move, or if it is in fact going to be more of a downtrending channel. Because I really thought we revert this move here would have reversed this, a little bit of a downtrend we had going on over the last few days. That reversed it, and so that takes everything off the table. But as you can see, the TSI is starting to falter just above the zero line, and momentum has kind of just went sideways now. The momentum on the Russell, as you can see on a weekly basis, has actually maintained its trajectory from what it had a couple of weeks ago. Now, one can, kind of say, okay, well, it's working off its overbought condition by the momentum falling, which is true. It is a good, healthy sign that the price is just consolidated. It hasn't fallen down dramatically. We haven't had any really huge sell-off weeks to give us any indication that a larger, more significant sell-off is around the corner. So anyway, that's what I'm seeing here, Mike. Michael, you seeing anything else that I may be missing?
I mean, how do you interpret this, that in the last 2 weeks we saw Nasdaq strongest, Russell weakest,
Yeah,
and SPY in between,
yeah,
and Dow Jones maybe got this once in a lifetime 20,000 type.
yeah. There was and what was really funny is this time, and I'm gonna go tangential on you just a little bit. Is what I found very interesting is that the Dow hitting and closing above 20,000. The hype on that's typically from the talking heads, from the markets, and from the financial networks. It seemed like the celebration was muted. I don't know if that's because there's anticipation of greater things ahead. I don't know, but I can remember where milestones were hit in the past on a lot of the several on the indexes, and the financial networks would just go absolutely bananas, thinking ringing bells, wearing hats, blowing confetti all over the place. And this time it didn't happen. Yeah, there was there was an acknowledgement, a little bit of a celebration, but nothing as dramatic. So just so I don't know. To your question though, I think a little bit of it may be. I do think in a way it's related a little bit. It's a little bit has to do with the seasonality. The Russell tends to have, the January, February, March into April tends to be kind of a confined and slow time for the Russell, and because normally it's coming off of a huge gain in the October, November, December time frame. Well, of course, the Russell, this move back here on the Russell from just before the election to the first part of December, that's a 20% move. And so there's a lot of digestion going on. There was more to digest, and I think that may have retarded the move a little bit as compared to the other indexes. And you know how the ebb and flows goes between indexes. The Nasdaq can be running hard and heavy, S&P kind of sitting still, Russell showing a little bit of weakness, and then all of a sudden you start getting the sector rotation out of in this case the tech stocks, either back into the S&P type stocks or into the small caps for the Russell, and then they spurt up and the other one goes sideways to slightly down. And so Bob Pisani of CNBC is now free. What does that mean, Joe? Did he leave them? Did he become a Maria? So while Joe's answering that, so good question though. So let's get back to the other stuff at hand. So that's where the market's going. Here's where I left this slide in. I just want to highlight to everybody that we're keeping our eye. We do not know if this year is going to be like past election, post-election years or not. But this does capture 65 years worth of data. And what happens? Here's Inauguration Day. And the market has a tendency to continue to go up for approximately 12 to 15 days. Oh, okay. Oh, I see. He's now free because he's been tracking Dow 20,000. So it met its objective, and now he can turn to bigger and better things. So then about 2 weeks after it, the market tends to roll over, and this is on the S&P, rolls over, goes into a correction for about the next, let's say 12 to 15 days, and then moves sideways for sometimes several months. But this is a projection. This is a daily chart from the day of the election, which is here, through inauguration and onwards. And this is kind of interesting, that regardless of what president, where there is a change of party in the White House. This is very similar to what we're seeing and what we've seen in the S&P. Like I said, after the election, is it exactly right? Exactly correct? No, but in general, we've had a nice run up, and now a little bit of a pullback, and now a little bit of a run up here. And maybe it takes like 15 days for the honeymoon to be over. I don't know. But what I'm looking for is basically, is the current market going to follow historic norms? And we'll see how that works out through the rest of the year. But it's something to be aware of. And as you can see, even from the charts themselves, we've got a lot of things that are extended, and they get extended real quickly. A lot of the stocks that we're looking at get extended and are extended right now. And if we missed, we got into one this week, and we're trying to get into another one as we speak. But it may just, with the markets being extended, the upside expectations are a little bit lower than what they would normally be, especially because of the time of year it is. Here's that same chart. I did not show this to everybody last week, but what this is the pink line is the normal path of the S&P on a normal, just on the full average across the years. The blue line is the election normal, or the post-election normal, and as you can see, it follows more or less a path, from January, pop up a little bit in February, then drop off into the latter February, March, first part of April time frame, then takes off for a spurt, sideways to September, and then takes off again. Slightly different than the pink one, but there is definitely a time, if we're looking to go long the market, where there may be a more opportune time, and that tends to, in this environment, tends to be, in the February through March time frame. And we'll be looking at, if we get if we get a nice fall off and then a consolidation, we may be able to walk away and say, okay, this, the index appears to be following historical norms. And if it doesn't, if it pulls back a little bit and then shoots off and takes off like that, because of something that was done with the new administration or actions that have been taken, then we'll go, okay, this year probably isn't going to be the same. It's not going to follow per se the historic norms. But one thing I've found out about historical norms is that even though the chart may not follow it exactly, if you go to where these typical lows are, like here's one in February for the S&P, that oftentimes, even though the chart of this year's S&P may not be the same, around that time frame is when, things can tend to take off again. And I don't know if that's because of the that's just a timing mechanism for inflow of money into the index or into the market. I mean, it definitely could be, because when do people think about, they have to get their 401ks funded for the year? Well, typically they're going to be looking somewhere between sometime in March up to the 15th of April, before tax season, right? Or before the tax day. So something to think about, something to keep in your back pocket. So path of least resistance. So last week, Michael, give me your path of least resistance right now, man.
Well, I think in the next 2 weeks we should get volatility back.
Okay.
And then it gets a little bit more exciting. Then we will. I think Yeah, so I, I can be really wrong, but I think the next resistance is more on the downside than the upside.
Okay, so the path of least resistance, uh, and I could definitely, buy into that. How much downside, I don't know. Again, we have to remember we are in a longer term uptrend, and so, and we have to treat any pullback or any negativity, at least for right now until proven differently, as an opportunity to buy. And so we're looking for these pullbacks, and it may be I would like to see a really good, healthy, 5 to 10% pullback, because that would help reset a lot, and then I
Yeah.
think clear the path for potentially more upside. And so, but I can see us basically kind of I won't necessarily say driving, well, perhaps driving sideways through the end of the year if historical norms do in fact kick in, and in between that period over the next year, swinging from a brief corrections to a pop-up in the indexes. Longer term than that, I have to side kind of with Mike Traeger, who is more over here on the bearish camp. But I can also see, Michael, I can see um, the enthusiasm, the optimism continuing as long as good news keeps coming out about what the current administration is doing to lessen the burden on industry, to provide jobs and doing all that kind of stuff, that could in fact drive the market considerably higher and putting it almost into a condition like it was back in 1998, 1999 time frame, where there would be people, and when people start coming out and start saying this time it's going to be different, all the rules are being rewritten, that we're probably getting close within 6 to 18 months of an actual real strong top.
Yeah, I mean, when markets get in a euphoric mood, it's difficult to be a bear, or also to take profit as a bear.
Yeah.
And I mean, what could be is we have now for a month or maybe two great news from the US.
Yeah.
And then maybe good news from Europe. Then Brazil is doing much better than expected. Then
Yeah.
maybe Japan is, yeah, exactly. This week I read that Japan has excellent export statistics.
Okay.
So,
interesting.
yeah.
Okay, but we got to move along here because, but no, that's good stuff. So here's where we sit with where we are so far to date. We had a couple of these for strategy one we carried forward with us from last year, and they stopped out on us. No strategy 2 trades yet, and we just been continuing on with the strategy 3 trades. Just want to remind everybody that I am a firm believer that oftentimes traders get involved in trading strategies before they have a solid system below them. And with the active trend trading, we provide training on what this system is here with examples. We provide that training every Wednesday night. And then attached to that is I attach 3 different strategies. And members do not have to play in each one of the strategies. They can, if you're getting started, first of all, we'd want to focus over here in strategy 1 and leave the option strategies alone until, and the other thing I push towards is, hey, paper trade first. And so we just finished up this past Wednesday night with seasonality tied to the ETFs. We have completed the January webinars for the Bay Area Moneymakers. We will be having if you're in the San Francisco Bay Area, we will be back at the Masonic Temple in San Jose, California on the 4th of February. And so if you can come down and for a live, and also come down for a nice brunch that we do, you will enjoy that. And so I've shared everybody about having a Twitter account. I don't tweet a lot. But I just use it for just primarily a notification thing. But we also have the Active Trend Trading Facebook page where we do some live broadcast also. So the Active Trend Trading is based on the 5 pillars of trend trading: what to trade, top quality IB growth stocks and top-notch ETFs, when to enter, when to exit, what strategy we're going to use, and what to expect. So that's where we kind of finished up last year with strategy 3, which was our most successful strategy last year. And this year we're going to actually increase how much is dedicated to strategy 3 up to about 30%. We're sitting right now at about 26.6%. So as a reminder, through the end of January, we do have and also for attending this webinar, we do have a reduced level for both of the services we offer. And so I forgot to change that picture. Oh well. I'm waiting for CNN to come in and fill in all the bodies and that were there for the inauguration. That's a joke. But anyway, hey, keep the egg growing. 2017 is looking like it's going to definitely be a year of explosive growth. And so there's the Twitter account. We're going to be moving over to, I've got about 2 minutes. We'll be jumping for premium members over to the next final hour. Eric has asked me to look at LABU. Sure, I will do those two, and then I got to move on. Susan asked me to do one for CL, and so they're going to be quick and dirty because I definitely have to reach over to the other. Oh, good. Okay. Okay. What am I looking for? LABU. LABU is a 3 times leveraged. Oh, this looks really good, Eric. It would basically see your tick up here on we just went positive. We here's yesterday, and look at TSI has gone positive today. Momentum has continued to move up, and if you're an end of day trader, if you close above that 8-day moving average, or it doesn't go much further up, because it's right into a congestion area with resistance on the 50, the 200, the 100, the 8 and the 20. Everything is all right there. So but that's worth a nibble, I think. And then because let's see, if it falls about, that's 9% down to the bottom, so you definitely would not want it to drop that far. And so what would I do? I'd come here to where is it crossing, and I'd basically say, okay, I put my stop loss right below that level right there at 65.63, and so 65.63 from the current level would be about 5%. So I like that. We may have to buy that on the next hour. And CL. Okay, CL got whacked with earnings. That's called Colgate-Palmolive. Let's take a look over here on the weekly chart real quick, Susan. This looks like a typical flag type pattern where you drop real heavy, ran up the flag just a little bit, and then it has now broken down below that, the flag level. And so, the way you measure those flags, you either go from the high here or the high here. We'll just use this one for the time being. And now it's broken down below that and giving you a projection on where it might go. And so we'll take this down here, put it at the bottom of the flag, and that's showing us that we may get a drop down here to the 55, 56, 56 level over time. I would want to look at let me blow this up a little bit here. And it hasn't been down. Larger picture though, it looks like, yeah, I mean, you've got a little bit of support here at 62, but that is definitely a a large drop off. I don't know. Did they miss their numbers? They missed their street numbers. Okay. So that's what I'm.
Yeah, all these consumer stocks are falling down.
Yeah. Yeah, yeah, because that is definitely a really, bearish move here. I mean, I wouldn't short it here, but if I get any type of move back up in towards the middle of that hammer or in the middle of that, I would look, if it was going to be shortable, I would look to short it about 60, somewhere 65, 81, so 65, 66 area. So that's my technical on that one. I mean, but this is just a classic. What appears to be a flag pattern, and the flag patterns, to complete themselves, typically run the same distance of the pole. And I'm not going to take from the top because I'm going to be a little bit more conservative in the length of my pole down to here, and then we're going to drop, and that puts you down about the 66 level. So does that work for you? Are you a long-term holder on Palmolive, on Colgate? I know a lot of people. Okay, yeah, I know a lot of people have. Some people have thousands and thousands of shares of things like Walmart. Like, well, some people Walmart, but things like Wells Fargo, Colgate, that were bought a long time ago just for the dividends, if you will. And so, what this might be setting you up for, because I know a lot of times people don't want to separate themselves from the stock for various reasons, is looking for opportunities to sell calls against it. And I'll pop this up really quick, and then I really have to go to the next session. Let's pop this up really quick. That's not what I want. Let's draw this one over here. And so, yeah, it looks like you could have some real fun with Palmolive, because it does do weekly options. And so it's a very low volatility entity, but you could probably pick up a little bit, especially if you use your intraday charts to figure out where you'd want to sell positions. So like right now, the and at the money call is going at 50 cents, let's say 51 cents. That expires next week. I wouldn't say that's where you want to do it now, but it gives you a flavor for what type of a turn you could make. And if you have, some people have like thousands of shares of these, and had a work with a young lady one time who had like 5,000 shares of Wells Fargo, yeah, but she was fearful of doing covered calls on it because she said, what happens if I'm called away, because my mother gave these to me? And I try to explain to her, well, you can always buy them back if they're called away. And she goes, but they won't be the same stock. So anyway, okay, hey guys, have a great weekend. Bless you all, and God bless everybody. Michael, we'll talk next week, okay?
Yeah, that's great.
Okay.
See you. Have a nice weekend. Bye.
Bye-bye.